I'm here with John Thain, Chief Executive of CIT Group, who 5 years ago was in the room at the New York Federal Reserve when the fate of Wall Street was being decided. At the time, he was running Merrill Lynch. After that momentous weekend, the company was sold to Bank of America. Mr. Thain, thank you for being with us. 5 years ago, you were at the center of a historic moment for Wall Street and perhaps the world financial industry. How have things changed since then?
Sure, Francesco. First of all, thank you for asking me to be here. I think the most important change is there's less leverage in the system today. So consumers are less levered, the housing market is less levered, and certainly financial institutions are less levered.
And so does that make for a less risky financial system, or are there risks lurking elsewhere in the financial system or even in the shadow banking system that we now have?
Well, there are always risks, but the lower levels of leverage, I think, means that the system is less risky today than it was in that period of time leading up to September 2008.
And do you see this as a structural issue? In other words, leverage among consumers, corporations, and financial institutions is likely to remain much lower than it was, or will we see a cycle whereby leverage starts growing again?
Well, so this is the question of these, can these things happen again?
Right.
And if you look over the history of markets, there have always been these periods of time where you get too much leverage, too much exuberance, you get a bubble of some kind, and then the bubble bursts.
Right.
So right now, we're in the post-bursting of the bubble period, and so I think that leverage will stay more moderate for a while.
Right.
But at some point in the future, you have to worry, particularly with rates as low as they are, that there's some bubble forming somewhere.
Are you seeing any signs of that in any pockets of the financial market yet, or not?
So yes, we are. So in the larger leverage buyouts and larger leverage deals, we are seeing the terms getting more loose, and we're seeing more leverage.
And it's interesting that you say that, because of course we saw ultra loose terms just before the financial crisis among the private equity leverage buyout deals, and yet that wasn't the cause of the crisis, really. It was a whole set of other things, including very leveraged financial institutions. So do you see that being a problem structurally, systemically for the system?
I don't see it right now. I think that, again, we're post bubble bursting. We're still in a more conservative phase. But you are seeing leverage start to creep up.
And among consumers, individuals, households have went through probably an unprecedented period of deleverage. Are you seeing that starting to pop up again?
No, not really. I mean, we don't really have a lot of consumer businesses, but it doesn't seem like the consumer is starting to spend. So if you look at retail sales are not great. It's a little bit depends on which part of the industry, but I think consumers are still pretty conservative because many still are negative in terms of the equity in their home, and the stock market's come back, but I still think that with unemployment where it is, the consumer is still going to be pretty cautious.
And you had a long and very varied experience on Wall Street, and you had a lot of experience at Goldman Sachs with risk controls and everything else. So how do you judge Wall Street banks' preparedness for the next crisis?
Yeah. Well, the problem is the next crisis is always different than the last one. And of course, all the legislation is dealing with the last crisis. But the fact is that Wall Street firms, both banks and one of the old traditional investment banks, they have more capital now. And that's probably the single biggest protection, is that they are better capitalized than they were, and they have less leverage.
And of course, they say we have more capital, which is a good thing, but it drags down our returns. So is that a new era for Wall Street, that investors and employees and executives will have to adjust to an era of naturally lower returns just because of the capital that they have?
Yeah, I think that's right. I think in terms of returns on equity are going to be lower than they were, post 2008. And I think that is because they will need to operate with more capital. I don't think that's necessarily bad.
Although, but investors, and let's face it, employees as well, who have benefited from the high profitability of these banks in the past, may see it differently, right?
Well, you have to look at the relative return. So we're in an interest rate environment where 10, 12, 14% return on equity is still a much, much better return than you get in the fixed income markets. And even with these lower rates of return, you see the stock market at or near all-time highs. So I think it's okay.
Mm-hmm. And there's, of course, you touched upon this, there's a new era of regulation as well coming up. Banks complain, and they say that there's too much regulation. What's your stance on that?
Well, I think, again, this is what happens after a bubble bursts. This was a particularly big and very unfortunate bubble, but there tends to be more regulation, and it tends to be over-regulation, at least for a while. We saw the same thing with Sarbanes-Oxley, post-WorldCom and Enron. So much of Sarbanes-Oxley was good, but certainly parts of it went too far. Yeah. And I think we're seeing the same thing now. So much of Dodd-Frank is good, but the fact that they can't write over half the rules in 3 years tells you it almost certainly went too far.
Right. And so is there any aspects of Dodd-Frank that worry you, of the ones that they've written the rules for? Or?
Well, as I said, I think a lot of it depends on how it gets implemented, and many of the rules still aren't written. I think that the higher capital levels are generally good.
And what do you say to people, mostly in Congress, but even in the regulatory world, that say banks and financial institutions should be boring, should be utilities, and with the implications that the returns will be much lower? I mean, is that the right way to go?
Well, yeah, it's obviously the trend now to have boring banks and boring bankers, and I think that that's okay at the moment. But a lot of innovation also comes out of the financial institutions, and all of that innovation is not bad. And so I hope that we get back to the point where innovation is still good, and that the U.S. is the leader in the world in the financial markets, which I think it is.
So you don't see the current environment, the regulatory environment that you just described, as being stifling of innovation in the long term? You think that will still come through?
I do. I believe this industry has some very, very smart people, and they're always trying to solve problems for their clients and trying to make the market more efficient, and I think that will continue.
Even though the incentives may be lower than in the past, both financial and otherwise?
Well, yes, I think that's true. I think that that's not necessarily bad. I still think that the industry is attracting some of the best and brightest people, and I think that will lead to innovation.
One of the big issues that you faced in that room at the Fed 5 years ago was the issue of too big to fail, right? These banks are too big to be allowed to fail. Do you think we have resolved that issue right now?
No, not at all. We still have the issue of too big to fail. If anything, the biggest financial institutions are a bigger percentage of the total of the financial industry than they were before. So no, we haven't solved that. I think that the number of institutions that are really too big to fail is small. Right. It's probably less than 10. Right. But we haven't solved that problem.
And so if we were to find ourselves in a similar situation, I don't know, 5 years or 10 years down the line, we still have the same problem that you and others faced 5 years ago.
We do, and part of the question will be, how do you deal with that? Because we have had large financial institutions either fail or come close to failure. So way back in the old days, I was involved in the Drexel bankruptcy, and we had long-term capital almost fail. And then, of course, we had Bear Stearns and Lehman, and I think a lot of it is how you deal with it. But I think it's still true for those very large financial institutions, you cannot allow them to simply fail in an uncontrolled way.
Right. The way it was dealt with 5 years ago was, by and large, through deals, through mergers, including Merrill Lynch and Bank of America. Mm-hmm. Is that the way forward, do you think, in the future as well? Or?
Well, I think that's one way. I mean, right. So in the case of Merrill Lynch was certainly in very severe financial stress, and I solved that problem the old-fashioned way. We didn't have any government money. We didn't have any government involvement. Merrill Lynch was sold to Bank of America for what at the time was $50 billion. And from the shareholders' point of view and from the employees' point of view, that was a very good deal.
But it's to your point about big institutions have become even bigger. At some point, the consolidation play will become less useful or even impossible, right? Because you can't merge two massive financial institutions.
That's true. So let's go back to the very old days. So in the case of Drexel, when Drexel failed, the pieces of Drexel were actually parceled out, but in a controlled way, not in an uncontrolled way. So different institutions, one institution took the treasury book, one institution took the mortgage book.
Right.
It was a simpler time, but still it was broken into pieces and spread around in a controlled way.
Which presumably you can do if you have one institution failing at the time, but if you have like the whole system collapsing on itself, that becomes more difficult, right?
Yes, the key is to not get to the point where the whole system is collapsing on itself.
Right. Are you confident or hopeful that we will get to a point where we have a resolution authority? In other words, a way of having one of these banks not failing uncontrollably, or is that not going to be a happen?
Well, I think that is the key, is to have the mechanism to either merge or wind down or break into parts these financial institutions, but in a controlled way. And the mechanism to do that, I think, is not clear yet.
So does that surprise you? 5 years from the financial crisis, we still don't have solved one of the biggest problems of that crisis.
No, because it's a very difficult problem. And so it's not easy to solve that problem, and it has never been easy to solve that problem. And if you take one of those large firms, they're so big, they're so interconnected, they're such a part of the financial system that even today it would be hard to manage.
And you subscribe to the view that they are just too big? So that's one issue, right? One solution that some people propose is let's make them smaller so they're not too big to fail.
Right, so the problem with that is the competitive situation in the world doesn't really make that very practical. So Deutsche Bank is also too big to fail. The Germans aren't going to let Deutsche Bank fail. The Swiss aren't going to let UBS fail. Our U.S. financial institutions have to compete with them. And so they have to compete with them globally. So just breaking them up isn't the right answer.
And I'd like to ask you one question on the shadow banking sector. Right? So naturally, perhaps, the regulatory focus and the political focus has been on the regulated banking sector. Are you concerned that risks are building up outside the regulated banking sector, which will end up with some problems later on?
Well, I think one always has to be worried about that. And so whenever you have a very tight regulatory environment and you have very low interest rates, so there's an incentive to push risks other places, you worry about where those risks are going and what are the nature of the institutions that are taking those risks. And I think that's true today.
Do you see any particular type of institutions? Some people mention hedge funds, some people mention private equity groups as the receptacle of that unseen or rising risk.
Yeah, it certainly is in some of the hedge funds and some of the BDCs that were created. Business
Development Corporations.
Exactly.
Right? Yeah.
And so those are two of the places where you see the risk. But it's always hard to know kind of where the next problem is going to be, because if it was clear where it was, then someone would deal with it.
And you started off by talking about leverage. So leverage is a good indicator, right? If we look at where leverage is building up, that's a good proxy, I suppose, for risk. Do you agree? I mean,
I do agree with that. And as I said before, leverage is still across the system still relatively moderate.
And one final question on CIT. Within this changing financial landscape, where does CIT fit, in your view?
So CIT is a commercial finance company. So we lend to companies, mostly middle market companies, and we lease equipment, again, mostly to middle market companies. And so we provide financing to small and middle market businesses, which actually create about 2/3 of all net new jobs in the U.S. And we lend to them primarily against collateral. Yes. So we have collateral to protect ourselves if they don't pay us. Mm-hmm.
That's the equipment or something else?
Yes, whether it's equipment or trade receivables or rail cars or airplanes.
And do you miss the other part of Wall Street? Do you miss being in a big financial institution like Goldman or Merrill Lynch? Or?
Well, so if you look at my career, so I spent 25 years at Goldman, but then I went to the New York Stock Exchange, which is a relatively small from a business point of view. Then, of course, I went to Merrill, and then I went to CIT. So it's not so much the size of the institution, it's dealing with institutions, particularly in the case of Merrill or the New York Stock Exchange or CIT, that were damaged or were broken, and usually by prior management, and then fixing them. And so CIT has been fun for me. It's a different business. I didn't know about airplane leasing or rail cars, but fixing it and getting it back to its competitive position, which it is now, and fixing both the asset side of the balance sheet and the liability side of the balance sheet, that's kind of the challenge. And that was true at the New York Stock Exchange, that was true at Merrill, and so that's what I find fun.
But now that it's fixed? It is fixed.
Yeah, it is fixed. So now it's a question of how do we grow it, and where do we find new avenues to lend? How do we basically help the U.S. economy start to grow more? And so that's what we're focused on now, is how do we grow?
Great. Mr. Thain, thank you so much for being with us.
It's a pleasure. Thank you.